I think there's an idea out there in general that has some currency amongst traders and investors that the Fed will step in once the markets go down more than 20%, and they won't allow the markets to drop further than that. So I think that's what we're seeing more than anything else. I think it's that belief that back in sort of the end of May, about 10 days ago, we saw basically S&P 500 hit sort of bear market territory, and that's where the Fed says enough. We're not going to allow it to drop any further. Even if they haven't said that publicly, they're probably thinking that in the backs of their heads, that we've gone far enough with these interest rate increases. We might see a couple more, but then we've got some flexibility and we're going to wait and see. So I think that's what's driving markets sort of sideways and slightly up in recent days, is that belief. But I think those people are going to be disappointed. I think the Fed has its back against the wall in terms of inflation, and they're going to have no choice but to hike rates much further than they have so far.
That's interesting because, as you point out, we saw people like Mr. Bostic trying to row back on suggestions that there is such thing as a Fed put this year. What about the other argument that the markets were making as they tried to be more upbeat on the data, that actually we're going to see the Fed pause in September because we're going to see some of the drivers of inflation ease, like energy prices and food prices?
Well, I think what's driving the increase in inflation is basically the Fed's monetary policy, and they pumped so much liquidity into the markets that this has now come back to haunt them in the form of inflation, higher prices. So I don't think the upward pressure on those prices are going to decrease unless the Fed really starts to decrease and run down its balance sheet, which is so bloated and inflated right now. So they're going to have to do something on that front. I mean, basically, they've increased interest rate. The Fed fund rate is still under 1%, and historically speaking, that's a very, very low interest rate. Now, they've been talking about increasing it another 1% over the next two meetings, 50 basis point increases for two meetings. That would take the Fed fund rates down to just below 2%, which is still pretty low, historically speaking. So that's not exactly a strong inflation fighting stance. I think they're going to have to increase interest rates much, much further than that. And I think inflation is going to be very, very stubborn. It took us years to get into this situation now, and it's going to take a year or two to get back out, I think.
Yeah, Octavio, as much as I'd like to, it's very, very difficult to disagree with you, sir. Look, there are expectations of circa 3% interest rates in the United States as things stand, cateris paribus, at the start of next year as well. But if we have inflation anywhere near the current levels, and for the real world, that means 8 to 8.2% at the moment as well, just to underline your point, that means we are still massively in negative real rates, isn't it?
Absolutely. We're massively negative real rates, but I don't see that being a tenable and a sustainable position. You can't have negative real rates for a very long period of time. People just pull their money out and push it someplace else until those things adapt. So I don't see where they go from here other than continuing to increase interest rates until we get into some sort of real interest rate territory there, and basically means drawing down their balance sheet. I fear that it's going to have very negative impacts on large parts of the US economy. I think the housing sector is going to suffer really badly as those interest rate hikes start to really bite, and they have already started to show signs of this. I will say US housing has been more resilient than I expected. I thought with the basically a 30-year mortgage rate more than doubling over the course of the past 12 months, we would have seen more fallout from that. But I think there's more pain to come, particularly as the Fed starts to draw down its portfolio of mortgage-backed securities, which they have not done yet. They're still sitting on trillions of dollars of mortgage-backed securities, which they're going to have to draw down, and that's going to drive interest rates on mortgages even higher than the 5.3% we most recently saw.
So there's that lazy old assumption out there that I'm sure you and I have talked about previously, that's great for banks, though, which is one of your specialities. Net interest margins are going to go through the roof. We're going to make hay. But that's not the case, is it? Because your credit quality is going to go downhill fast for a lot of people you're lending money to, isn't it?
Well, absolutely. So the credit quality will come down. People won't be able to afford their mortgage payments anymore. I mean, I think particularly in the US banking sector, there's a lot of mortgage refinancing that takes place. And that, of course, disappears and has basically disappeared as people basically say, I can't refinance my mortgage now at lower rates. I'm going to stay at the rate I'm currently at. So that was a very big source of drivers of revenues for a handful of banks, certainly people like Wells Fargo. I wouldn't say they're dependent on that, but that was a big driver of their revenues, is basically mortgage refinancing. That's gone away. So yes, credit quality will deteriorate. But to your point about net interest margin, I think there's sort of a misconception there sometimes that some bankers sort of seem to think that it's the absolute level of interest that's important. No, it's not. You can have very high interest rates but very low net interest margins. What's important is actually sort of the yield curve and the term structure. And if that sort of flattens, it becomes much, much more difficult as a banker to make money. So it's really the difference between long rate and short-term interest rate that's important to a bank. It's not so much the absolute level. There's very little correlation between net interest margin and the absolute level of interest. So because interest rates go up doesn't mean they're going to make money. Yes, they'll normally make more money, but they're going to have to pay much more in interest expense.